Hey! All right, so I'm going to make this quick. This is a short presentation. I did this the other day for my investor Q&A, but I wanted to go over the basics of this because I wanted you to have it in case you missed it. So this is my 6 reasons why I think now is the time to be investing in apartment buildings while I'm going to be doing this, building a real estate portfolio the way that I'm going to be doing it. And I'll just cut to the chase and go straight to it because if you're like me, you'd rather that. So number one reason why I'm doing this, I'm going to use my handy dandy whiteboard. Hopefully you guys can see that. And I'll be quick. I try to keep this in like 6 minutes, which would be awesome for me. So number one, and this is what I went over. So we're looking at capital preservation. Boom. Basically, don't lose money. Can you guys see that? Yeah, I'm pretty sure you can. So capital preservation, that's where we're at. That's huge. Like Warren Buffett's rule of investing. Rule number one, don't lose money. Rule number two, don't forget rule number one, right? Pretty simple. Like what I'm looking at is irreplaceable assets, institutional quality apartment complexes that cannot be destroyed, cannot be taken away easily. The bigger, the better. And it's something that other players want, not just a random beat up fixer upper properties, but actually great properties, great locations, because I'm looking at putting money in investing there long term. Right? This is something we're going to get. We got a basic structure and we want to lay our head on our pillows that night and rest. All right. So number two, and I wrote this down so I don't get long-winded. We're looking at cash flow, right? Cash flow. I'm gonna money sand like cash flow is king. Without cash flow, you cannot grow wealth. So at some point, the only way to buy cash flow or to create wealth is to buy cash flow. And apartment complexes that are already income producing assets, great properties, great locations. That's the best way to get cash flow that I know, right? And from there, we also have appreciation. Appreciation. Boom. Bam. So when we take a look at appreciation, we know we can raise rents because apartment complexes that are based on their income, the value is based on income, period. And right now, what do you hear? There's no rent. Rents are high. And we're moving away from a homeowner society into a rental society by choice. People are going to be moving into rentals by choice. And if you have a great piece of property, great location in a great city like California, San Diego, people ain't leaving it like everyone says. You're always going to be able to raise rents over time on a long-term hold on a property, knowing that we can force the value up and we can utilize the property for what it was created for, is to create wealth, right? Number four, leverage. We can get good debt, right? For every $1 buys us $3, right? So let's say, for example, we're looking at, I know in our first fund, we're going to be raising $5 million. We already know we're going to buy $15 to $20 million worth of real estate. And in our next fund number two, we're going to be raising $25 million. So we know we're going to raise at least 75. We're going to be able to acquire $75 million worth of real estate. Why? Because the banks are our partners in these properties. I'm going to be looking to get good debt on these properties. Right now, debt is cheap. Money's cheap. It's like 3.25, 3.75 long-term, 10-year interest-only debt on these properties that we can get for income-producing properties when they're the institutional quality assets, institutional quality real estate. All right. Next, number five, we're looking at it for tax purposes. When you can depreciate your property, or we sell, we refinance, that's tax-free. We're going to save money on that. We can almost write off all of the purchase price of this property if we know that we're going to be looking at depreciating the property or accelerated depreciation on the property, which is what we're going to be doing. All right, and last but not least, we have scale. It doesn't make sense to buy one house, so we can buy one property, one apartment community that has 100 doors in it, right? There's it's the difference between buying one house or 100 houses. Naturally, it's easier to have a 100 unit apartment complex, 200 unit apartment complex, 50 unit apartment complex, depending on what we're looking at, as opposed to trying to buy 50 homes with 50 roofs, 50 toilets, blah, blah, blah. Like, this is different. And this allows us to scale quickly. Right now, even if you were to buy this because apartment buildings are an individual business, it's like being able to scale a business quickly. If you buy into an apartment complex, it creates scale. All right? So those are my big six if you take a look at it. But I'll be honest with you, capital preservation is number one for me. Do not lose money. This is a time frame where this is the opportunity for most people, and a time frame that people are aware of that. They're like, dude, we got our money in the market. The bank's paying, 0.001, maybe 0.25%. So worst case scenario, the way that inflation is going, as well as the future of the economy is going, it's better for us to have our money in real assets, a hard asset. And that's how we don't lose money. That's where capital preservation comes in. Like we said, cash flow is next. We're looking at income producing. The day we buy them, they're already making money. As well as appreciation, we know we can raise rents because we're in a good market, job growth, community growth. Everything is looking up as it relates to that. So we know we'll be able to raise rents, and therefore we'll be able to force value or appreciation into the apartment complexes. Leverage. We're able to get good debt because bank wants to do apartment buildings. Banks are still lending on apartment buildings. Fannie Mae, Freddie Mac, insurance companies, pension funds. All these people are putting money into the type of properties that we're looking at. Next, we got tax benefits. Whether it's tax deferred or it's tax free, whatever it is, depreciating the properties, offsetting our current income taxes based on being able to buy into or invest in assets. Because again, you're going to be a partner in these deals with us. You're looking at it from there. So you're a partner, you're going to get a K1, you get to offset your income based on the tax benefits of the property. And last but not least, we can scale quickly. We don't have to get 10 houses. We can get a 100-unit apartment complex, and we can rate. It's way easier to buy an apartment complex than it is a home. 50, 100-unit apartment complex, the debt is easier to get. Management companies easier to get. All the pieces and the players are easier to get. The profit margins are easier because there's so many people. It's harder to make a mistake. That's why it's easier to scale in apartment complexes. That's what we're doing and why I'm doing it. Am I 6 minutes? Bam! I'm only 30 seconds over. But anyways, I wanted to do this for you because this was a part of my Q&A. But inside of the Q&A session with my investor presentation, this is the reasons why I'm going to this. I can go deeper, but why? But these are my big six, and I wanted to share them with you so you have them. If you have questions, reach out to me at 808-778-1326. That's my personal cell phone number. You guys have it or you don't. Now you do. But reach out to me. I have nothing to offer you right now. My attorney says I can't offer you anything, but it is coming. Bell Capital Fund 1, it's almost done. And I'm going to reach out to all of the people who filled out an investor Q&A first, or the investor qualification form first, whether you're an accredited investor or not. But primarily this is for accredited investors. What that means is you got to at least make $200,000 a year or expect to make that in the next year, or you have $1 million net worth, not including your primary residence. Okay, so and it's not bad. I mean, if you don't have that, let's still talk. In worst case scenario, that just means the government says it's an arbitrary made up number that says you got to have this. You can have $199,999 that you made, and they'll say you're not accredited. So you're still intelligent. It doesn't mean you can't play. It just means there's some hoops that you got to jump through to make sure you're qualified for it. So, man, I love you guys. I appreciate it. I hope this helps get a better understanding of what I'm looking at when I'm doing it, why I think apartment buildings are the way to go for the next 20, 30 years. I think everybody's going to have to go that way. And if you have $100,000 minimum to be able to invest liquid right now to invest, this is the time to do that. And I want you to do that with me. I will not let you down. I don't have nothing to offer now, but let's talk. If you're ready to invest now because you got $100K ready to go, and you're ready to invest, let's talk. Let's figure out how that's going to work. If you want to schedule a call with me, let's talk to you. I can answer all your questions. Totally transparent. You get the opportunity to see everything I got, know everything, get all your questions answered, and I'll make sure that everything that you need to make a conscious decision can be done whenever the time is right for that. Okay, so I appreciate you. Let's talk. Welcome to Bell Family. Bell Capital is going to be something that's going to last for a really long time, and I'm looking forward to you being partners with me in that. All right.